So what's happening with the state and local tax deduction, referred to as SALT, is that the $10,000 cap has been increased to $40,000 at a max. It is phased out depending on your AGI, and ultimately it's basically at $600,000. It's completely wiped out.
Completely wiped out.
Yeah.
So if you make $600,000 or more, then you're limited to that 10,000.
Yeah, you'll be limited to 10.
Gotcha. But that's a significant difference for a lot of people.
Yeah. But it's definitely helpful, especially for people in Massachusetts where we have the high real estate taxes.
So we got a lot of stuff going on this year, right? We got a new administration. We've got tariff talk, right?
Yes.
That created some, I would say, disturbances in the markets this year, at least from February to April was a pretty big decline. But certainly the passing of the big, beautiful bill.
Yes, which some people are like, that's what it's actually called. And yes, that is.
So Meg Curry, our director of financial planning for a long time here at Beck Bode, is on today. She's been on the No Bonds cast before, and we're here today to dig into the big beautiful bill, some of the things within the bill that we've found, but also we've done some research. Meg's done a lot of research on what most people either might be interested in or curious about or even confused about. And the purpose of today is to just talk a little bit about the things that are financially to someone's personal plan and wealth. And one of those things has to do with tax brackets and how those are impacted.
Right.
And I don't know if you want to go through like what some of the things that are some of the changes from that.
So the current tax rates and brackets that we have came in Trump's first administration, and they were due to sunset this year, so something had to happen. So as a result of this bill, they are not sunsetting. They will be now made permanent, so that the rates are lower, the brackets are, I think, a little bit more generous. So ultimately, it's a lower tax rate for folks.
Gotcha.
That's now permanent. What happens with that is the exemptions went away. And that's where it leads into the standard deduction whole thing, which is another piece of it. But the rates and brackets, they're inflated every year. The rates are not, but the brackets inflate every year.
Gotcha.
Different tax stuff.
And when we're speaking of deductions and things like real estate and real estate tax, so one of the things that's a little bit different or extended, tell me about that, because there was a cap.
Right, yeah.
And that's there's a $10,000 cap on real estate taxes, correct?
Right, which ultimately resulted in an awful lot of people taking the standard deduction. So what's happening with the state and local tax deduction, referred to as SALT, is that the $10,000 cap has been increased to $40,000 at a max. It is phased out depending on your AGI, and ultimately it's basically at $600,000. It's completely wiped out.
Completely wiped out.
Yeah.
So if you make $600,000 or more, then you're limited to that 10,000.
You'll be limited to 10.
Gotcha. But that's a significant difference for a lot of people, especially when you live in a community or a city or town that perhaps doesn't have a lot of industry to support, and that a lot of the tax comes from that tax base in real estate, right?
Exactly.
So that's meaningful. So what you said was interesting too, is that because of that, a lot of people took the standard deduction, but that may change some things now.
Yeah, and I can think of one client, and I've already given him a heads up that I believe he will benefit by this. He happens to be single, which I think helps, but his AGI is definitely less than the 600, so it might be phased out, but not phased out, but it might be phased down a little bit. But I think he's definitely going to benefit by it.
Yeah.
And I've been thinking about clients that I've worked with and said, okay, this one's going to get it, this one's not.
Yeah.
But it's definitely helpful, especially for people in Massachusetts where we have the high real estate taxes.
Yeah, incredibly high real estate taxes, right? And speaking of like a client or somebody that's listening, certainly I think there's a few factors in play here with this being so new. And if you have a CPA or you're doing your taxes by yourself, I know you agree with me, but it's a good idea to perhaps, if you have a financial advisor, of course you work with us, to do a little bit of tax planning as the year goes along, right? To kind of try to figure out, okay, what are some things that are relevant changes for my financial picture and how I could be impacted positively with this.
Right. Exactly. So as you know, I sometimes review somebody doing a Roth conversion, and one of the things that I factor in prior to this were, okay, if they're already enrolled in Medicare, we don't want to bump up their premium.
Sure.
And we didn't necessarily want to raise their tax bracket. This would be another one to factor in. And it's not, as we always say, don't let the tax dog wag the tail, but, no, the tax tail wag the dog. I got that wrong. But that would be another factor for Roth conversion. It's like, what is the price? What's the benefit if it's going to increase, lose the deduction? To look at it and decide if it makes sense. Because I'm not saying don't do it, but just be aware of the impact.
Yeah. But, I think that's the name of the game, though, with a lot of things in our financial world. Is it's not necessarily always about, oh my gosh, I've got to definitively know what the black or white answer is in terms of what's going to be best. Like we often talk to clients about, folks that are still working, for example, is like, oh, I have the opportunity in my 401k to contribute either to the traditional side, which is a deduction from your income, which is a benefit, obviously, versus making contributions to the Roth side of the equation, which essentially is no deduction up front. But as that money grows and compounds, when you go to take that out, if it's in the Roth bucket of the 401k, you withdraw that tax-free.
Right.
So then the question comes, well, what's best?
Yeah. And that's where this comes into play too, that maybe the taxes that you pay now could ultimately, outweigh the fact that you're losing a bit of this.
Yeah.
So,
sure. Yeah.
But with the increased standard deduction, so not only did they increase it a little bit for this year, it is going to continue to be indexed for inflation. But especially for seniors, they always got as a single person, you would always get an extra $2,000. And then for a married couple, it'd be an extra $1,600 per person. And then with this bonus deduction that they talk about too, a maximum for a single senior is going to be a standard deduction of $22,750.
That's pretty substantial.
Right. And a married filing joint, it's going to be $46,700. So
much different than what we've seen in the past.
Significantly different. I didn't even think to look up what the other ones were. But that was like, even though there's this new SALT deduction that's increased, that some people still may not cross that 46K threshold.
That's incredible because, very well, we work with a fair amount of business owners that they have, of course, expenses, the business that they can write off, and that often can supersede or be much more than the standard deduction allows and so on and so forth. And so it makes a lot of sense for them, but that's an incredible standard because oftentimes folks that work for companies, their employees, I would say it's typical, for them to take a standard deduction and not itemize a lot of the times, but with a standard deduction being so much higher, this could have a incredible impact on the amount of money that they don't have to pay.
Right. And that was the amounts for the seniors, but even for somebody who's not a senior, single, it's $15,750 this year because that got increased, and $31,500 for
31. So that's an increase.
So that alone. So there will still probably be a fair number of people who will take the standard, which was what Trump's goal was when he first put these tax, rates, et cetera, into play back in 2017.
What about something that folks often talk about and ask about with respect to Social Security? What kind of changes, if any, has this bill brought into the fold?
So, very good question. There was a lot of talk about Social Security tax. Social Security income would not be taxable. Absolutely nothing changed whatsoever with the Social Security. It's still up to 85% could possibly be taxed, depending on the other income. No change. With this bonus senior deduction, it could be that some of your Social Security, even though it's considered taxable, it might actually get wiped out by the fact that as a married filing joint, if you maximize, it's $12,000.
Sure.
So that's sort of the play. But one thing about the bonus deduction, it's only temporary. It's only for 4 years.
Only for 4 years. Okay.
Basically Trump's term.
Trump's term.
25 to 28.
Gotcha.
Yeah.
Gotcha.
But that's something that could potentially get extended.
Yeah.
You know,
No.
even though I've said these tax rates and brackets are permanent, and a lot of these other things are permanent. Like it's permanent until somebody makes a change.
Right.
It's just what we had was the tax code of '86.
Right.
It's now the tax code.
Yeah.
I guess 25.
Yeah. Exactly.
Yeah. So it can change.
Yeah.
Just we'd have no idea when.
A lot of us talked about changes to certain types of income, like overtime and things of that nature.
Yep. So overtime, it's tricky. A lot of people are like, oh, and what I've said to, as an example to folks is, if your regular rate is $20 an hour, then your overtime rate is $30 an hour. It's not the $30 that is tax deductible or not going to be taxed. It's the $10 difference.
$10.
It's the $10.
Right.
But it can add up. I mean,
Sure.
if you get somebody who has a lot of overtime, and there is a cap on that, which I believe is 12.5 for a single person and 25,000. But that's not small change for someone who may do some substantial overtime.
I don't think so, but that is an important distinction, though, because what you're saying is that, okay, somebody paid their regular rate per hour, let's say is $20 an hour.
Right.
And let's say that overtime is whatever it is, 40 hours or whatever it is, but they work 45 hours. What you're saying is probably a misconception with a lot of people is that there's the benefit on that full 5 hours, and it's not the case. It's the benefit on the overtime rate on that 5 hours.
Right.
So the difference between making $20 an hour and $30 an hour, you're not getting the benefit on the full $30.
Right.
You're getting the benefit on the difference between your regular rate pay and your overtime.
Exactly.
Okay.
Yeah.
Which again is an
add
extension.
up.
You're sure.
It can
There's
add
no
up.
question about it.
And I believe it will be subject to Social Security and Medicare taxes.
Okay.
So, but that can be a benefit. But I still think this is not small change.
No.
Especially for some industries where some people get some hefty overtime. And their hourly rate could potentially be higher. I mean, you might have somebody who's making $50 an hour. So that $25 times 10, that's up.
Everybody drives, or most people drive. So car loan interest.
Car loan interest. So this is an interesting one. I was doing my number crunching. This again is only for 4 years.
Meg does a lot of number crunching, by the way, as director of financial planning. She is
I'm a
head number cruncher. That's right.
Head number cruncher.
Yeah.
So it's up to $10,000 of interest that you can deduct. And I did check. It is per year. But, and I'm actually meant to have Sarah double check my number, but I'm pretty confident. A 6% loan for 5 years to get $10,000 of interest in year one. It'd have to be a $181,000 loan.
Okay.
So
right.
I think it's great, but no one should be expecting to get a deduction.
Well,
for
get out there and get that
$10,000.
Bentley, right? Or that fully souped up Range Rover, okay? And take out that big loan, and then you can meet that deduction. Seems like a good financial decision to me.
Yeah.
Yeah. All right.
So I said, okay, if you take on a $50,000 loan, it ends up being just under $1,000 in year one, and it's not quite $8,000 over the course of the 5 years.
Gotcha.
So it's still something. It is not available to corporations. This is truly an individual, because $10,000 of interest for a corporation is probably very, possible with a fleet of cars, but they're not eligible for it. It has to be personal use.
Personal use. So it's not for something used for business. It's got to be personal use.
Right. And it has to be a U.S. manufactured car. And my understanding is the VIN is how it will be determined, because somebody commented. Yeah, somebody commented like, but all the parts are coming from all over the world.
Sure.
But it has to be manufactured in the United States.
Interesting.
And I believe it's the VIN that's going to determine it. So
okay,
it's not like
so
you
I don't know if you know
think
the answer to this, but so what process would someone go through to figure that out, right? Because
you know how you get 1098s for your mortgage interest payments?
Yeah.
And you get 1098s for education costs, and you get 1098s for student loans?
Yep.
I have a feeling a 1098 is going to come into play for a car and the VIN to be there.
Interesting. Okay.
That's my speculation.
Gotcha.
So that I thought it has to be U.S. manufactured. It has to be a new car. Cannot be used.
Interesting.
And
Okay.
that is effective this year as well.
Okay.
But it has to be a U.S.-based manufactured final product. It has to be here. So a Honda or a Toyota that is manufactured in the plant here is good. Manufactured overseas, it won't.
Very, very interesting. Very interesting. And
So
all
I
these
think-
little tidbits of information, like, because no, a lot of this stuff is not necessarily picked up on the news,
No.
right? And it's not the
No, they
thing,
just
so
yeah.
right. So it's sensationalized a bit, and like obviously a lot of the stuff that we heard about was like overtime
Right.
and things of that nature. And oh, one other ones I want to ask you about is, because you hear a lot about them, is Trump account.
Yes, the Trump accounts.
Yeah.
You and I have already had a little bit of a
We've had a
discussion.
lengthy conversation
Right.
about this, and I've actually, over the course of the last few months or so, because anytime something legitimate is changed or something new is offered, me being analytical as well, it's like, oh, I want to get in there and actually understand what the real world benefit is. It's like
Right.
like we were talking about a minute ago, right? Like the standard deduction being increased. To me, that's material for a lot of people. Obviously
yeah.
for seniors, but even the extent, because what did the standard deduction go from last year to now? What it's changed to for like a married filing jointly?
I think it was like 29. And
Okay.
it's now, and then it was going to be 30, and I think it's now 31.
Okay.
That's what I said.
Okay. Yeah.
Yeah, it's 31.5 now, and
Gotcha.
I think it. Oh yeah, no,
Yeah.
actually it was 30. It was supposed to be 30, but it got been pushed to 31.5 for this.
Okay. All right. So we're seeing material changes. And then when I dug in, talked to you about it, but then dug into the Trump accounts, I had a hard time coming to the conclusion that this was something that was to get excited about. But let me know your thoughts, or for the benefit of everybody here.
I'm kind of in the same spot.
Yeah.
It's good for 4 years only, 2025 to 2028.
Mhm.
Accounts cannot be funded until 1 year after the enactment of the law, which means July of 26. Although I did read something January. But any newborn gets $1,000 contributed to
Yeah.
the account on the by the government. So okay,
Great, $1,000.
$1,000.
All right, I'll take $1,000.
That's the yeah.
I'm
So
not
it's,
going to have any more kids, by the way,
it's-
but that's
yeah. So it's $1,000, and then people can contribute, and it's $5,000 a year. An account can get opened if the child is not yet 8 by the time the account is open.
okay.
Can continue to contribute until they're 18. Does have a little bit more flexibility than the 529 plan or the covered L and that type of stuff. For what you can withdraw, purposes you can withdraw. But it grows tax-free. But when the distribution happens, if it's for a qualified expense, it's taxed as long-term capital gain. So
Okay.
it only grows tax-free.
Gross tax-free. So,
right.
or as we say, gross tax-deferred.
Tax-deferred,
right?
yeah.
Right. So you're not
That's
getting
right.
taxed, and there is some lack of visibility even today in terms of how exactly, because I haven't found much on how exactly the money can or will be invested.
Very restricted.
Yes.
It has to be basic. I don't think I've seen it quite worded this way,
Right.
but it strikes me it has to be an S&P 500 index fund,
Okay.
something of that nature. I haven't seen a lot of discussion about this, but the sense I get is that firms like ourselves are not going to be able to manage it because the fee needs to be like 0.1% or something.
Gotcha.
So small accounts might not be worth it. And it's so limited as to what can be invested. And so it'll be interesting to see what the custodians come up with.
And do you know, because I wasn't able to really figure out along the way, right? So let's say it's invested in the S&P 500. Does the individual have the ability or the opportunity to make changes to the account? Like, oh, for example, and that what I'm getting towards is like, hey, when we go through the ups and downs of the markets over time, that's where actually people make the most amount of their mistakes. It's not about whether you invested necessarily in the S&P 500 or a different type of stock portfolio or this mutual fund. It has more to do with the decisions that you make along the way. So one of the questions I have is, fine, I have no problem with the S&P 500. It's an equity index, and it's a long-term account. You're getting exposure to some of the best companies in the world that happen to be here in the United States. But if you mess with it over time, and for example, like a lot of people do, unfortunately, in their 401ks over long periods of time, we go through a bad market period and they pull it out, put it in cash, and they miss out on the upswing. Is that something that could be an issue for folks that are in, I almost said Obama account. There was a one-time the thought of an Obama account too back in the day. I seem to remember
Yes,
that.
I do
Yeah,
remember reading that there was
yeah,
something, but it
yeah.
never
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 materialized.
materialized exactly.
Um,
I have not seen a restriction.
yeah.
I mean, 529 plans do have a comparable,
Hmm?
there's 2 changes a year
Yeah.
allowed. Um,
But one
and
could change that into a cash account to go flee to safety, quote
right,
unquote
right,
safety,
right,
and miss out on recovery. So
right,
this
yeah.
the business of
Mhm.
not having the ability to have a financial advisor. Now it might sound biased, of course, because we're financial advisors here, but obviously we're
Right,
here because there are a very large amount of people find an incredible amount of value in a financial advisor,
right.
and so it's interesting that
Yeah,
uh, how these accounts are situated.
yeah. Like I said, it's going to be interesting to see how the custodians come up with it because it's going to be a new account application, new restrictions and distributions. Who knows? Who's monitoring? Is it a legitimate, qualified?
Hmm.
But I mean, it's $1,000 for any newborn.
Sure.
You know, um, and if it withdrawn without being qualified, it's subject to tax as well as a 10% penalty, like anything else.
So if I were to sort of sum it up, because I'm not an expert on Trump accounts, but if I were to sum it up, it seems like the benefit is you're getting $1,000.
For the newborn.
Right.
And something I've read, and I'm not sure how this is going to happen, is they're saying that if the government sees that an account was not open for a newborn, they will open it for them. Like, okay, going to be an interesting one.
Interesting. Okay.
And we have a couple of clients who have newborns in 25s.
Very, very
Yeah,
interesting. So it's kind of that makes me think of like the default investment alternative within a
right,
401k is that if what is a common you find in 401ks today is that the plan document basically says that if a participant in a 401k plan doesn't
right,
assign a investment for the money that they're putting in there, there's a default
right.
investment that it'll automatically go into, which I think ultimately is a very good thing because with everything that we do in our daily lives, if this isn't your your forte in
Right, yeah,
terms of, or you just don't have the time to deal with it, your money's not just sitting idle in cash. It's actually being defaulted into
right,
something that
yeah.
can make it work at least a little bit harder for you than just sitting there. So that's interesting.
Yeah.
Anything else that you can think of, or you had in terms of notes that you thought people might be interested or might be a little confusing out there?
Um, One benefit, although it doesn't kick in until next year, is for people who don't itemize, which with the higher standard deduction, or maybe people won't be,
Yeah.
is do you remember during COVID, you could actually deduct up to 300 as a single or 600 as married filing joint?
Hmm.
Just on
Yeah.
that's coming back, and it's going to be 1,000 and 2,000.
Interesting.
Yeah, so
Okay.
that's kind of beneficial, but again, it doesn't come in until 2026. But and it has to be from everything I've read, it needs to be a cash contribution, the
Hmm.
clothing, etc. But it's like that's actually not bad because especially with this higher standard deduction,
Yeah.
it's going to be kind of nice
Yeah.
to you know
It
do
should be
them.
interesting to see. I don't know how often they publish statistics about it, but with the increases in the standard deduction and all like the bits and pieces here on how that impacts the tax picture for folks and how many
Mm,
people actually take the standard deduction
right,
this coming year versus
right.
in prior years. And
Yeah.
so yeah, I this is a great conversation. And I think one of the major takeaways for me, if I'm sitting in the shoes of somebody watching, is, geez, it probably makes a lot of sense to do some form of tax planning as this year moves
Right.
along to see, oh, what are
Yeah.
I've heard about all these different things. How is this
Yeah.
applicable to my own personal
Right.
scenario? Because I'll say that this is, if you work with a CPA or an accountant, this is going to be something that's going to be difficult for them to kind of
Yeah.
update and keep up with. So
Yeah.
I think that's a good idea for anybody to take a look at their own tax picture. And if you have somebody in your lives, a financial advisor or if you're a client of ours, certainly we want to have a conversation with you, but seeing where and what is applicable to you in your own financial
Mhm.
situation. And because the IRS won't make those moves for you. That's the thing, when it comes to, bettering your financial circumstances, that's something that's borne on you. And The IRS is not going, hey, you forgot about this deduction. We want to save you a little bit more money. But that's just not going to happen.
Yeah.
So it's good to reach out to the person that you can trust, and certainly we're here to assist. And I want to thank you, Meg, for coming on. Meg is always digging into some of the more complex issues that we face, that our clients are concerned about, and a tremendous help. So thank you, Meg. I appreciate it.
I have one last thing.
Oh, okay.
That bonus deduction for seniors,
Mhm.
it doesn't matter if you itemize or not.
Tell me more about that.
So some people were sort of saying, oh, standard deduction. And oh, by the way, there's an additional, but if you itemize, you still, as a senior, you still get that.
So you still get that. So you don't have to take the standard deduction. You can itemize and you still get that.
Yeah. So if you itemize and say your itemization gets you to 50,000, that 6,000 is still available.
Still available, and you can put it on top of it.
Right.
Interesting.
Yeah.
All right.
So
excellent. Well, thank you again.
Sure.
And
Thank you.
great conversation, and look forward to the next No Bonds cast and seeing everybody there.